does. Plus, Bangsar South is still very much an area under development. You've got major projects like Duo Tower, River Park ongoing or planned nearby. So construction noise, dust, that's likely to be part of the picture for the foreseeable future.
So it creates this kind of paradox, doesn't it? This sanctuary versus reality disconnect.
That's exactly it. The estate is engineered, designed as this insular sanctuary. Lush, quiet inside, but step outside the gates, and you're immediately in the high-energy, sometimes chaotic reality of Bangsar South. So for you, as a resident, the living experience is sharply divided. Can you truly maintain that internal peace, knowing the city buzz is right there?
It means choosing the estate isn't just about the luxury inside.
No, it's also about accepting this deliberate bubble they've created within a very active urban jungle. You have to be okay with that sharp contrast.
That's a really crucial point about the bubble. Okay, let's switch gears now. Let's focus on the investment side. For those of you looking at this purely as an asset, what does this all mean for your wallet? Let's talk financials.
Okay, from a capital appreciation perspective, the estate has shown a really positive trend so far. It launched around, say, RM 700 to RM 750 per square foot, roughly RM 1.7 million for a unit back then. Now, if you look at current asking prices for subsales, they range quite a bit, from about RM 741 PSF right up to RM 1,162 PSF.
Wow, quite a jump at the top end.
It is. So units are listed anywhere from around RM 1.99 million up to RM 3.13 million. And transactional data backs this up. It confirms a healthy upward trend. We saw prices around RM 688 PSF in Feb 2020, rising to RM 814 PSF by Feb 2022. For an investor, seeing both asking prices and actual transacted prices moving up like that is definitely encouraging.
Absolutely. And what about the rental side? Performance yield, that's often the real test for investment property, right?
Definitely. Asking rents here show a fairly wide range. Typically, you're looking at RM 4.212 PSF up to RM 6.21 PSF in rental terms.
And the yield, because that's a key metric. The yield potential is the really impressive part. Reports consistently cite it as being significantly high. We're seeing figures like 6.56% quoted from 2023 data. Some reports even imply yields hitting 7.52%, maybe even 8%.
That is high, much higher than the typical KL average.
Way higher. The usual Klang Valley condo average is more like 4 or 5%. So the estate seems to be performing very well on the rental front. And this strong performance, it really underpins what we call the niche product investment thesis for the estate. It simply doesn't compete with the flood of smaller units in Bangsar South. It serves a very specific, quite underserved, affluent market segment.
Who are we talking about?
Large families needing space, senior expatriates maybe on corporate packages, high net worth individuals who prioritize that space and privacy. If you connect this to the bigger picture, the scarcity, this niche positioning, it means less direct competition and gives you the ability to command premium rents, likely from high-quality, stable tenants.
But there's a trade-off there, surely.
Yes, there is. The trade-off is that you're dealing with a smaller, more specialized tenant pool, which could potentially lead to slightly longer vacancy periods between tenants compared to a mass-market condo.
Right. And then there's the ongoing cost of ownership, specifically maintenance fees. We noticed a bit of a discrepancy in our research. Some early sources mentioned RM 0.25 PSF, but a more recent agent response quoted RM 0.29 PSF.
Yeah, that's a 16% difference, which is not insignificant.
Exactly. For an investor, if you've run your numbers based on 25 cents, it's actually 29, that directly impacts your net yield. How should people approach that uncertainty?
You've hit on a crucial point. That discrepancy absolutely matters for your bottom line, your net yield calculation. Our indicative scenarios, based on asking rents and these costs, show potential net yields ranging from maybe 5.94% up to 7.41%. But it just highlights how vital it is for you as an investor to verify that current maintenance fee directly with the building management before you commit.
Get the actual current number.
Absolutely. It's an operational cost uncertainty you need to nail down to project your returns accurately. Don't rely on old data or assumptions.
Okay, solid advice. So let's place the estate in its competitive landscape properly. How does it really stack up against its neighbors? What's its actual market position?
Right. If we look at the immediate competition, the comparable condos in Bangsar South, you'd think of Goodwood Residence, Novum, Southview, maybe KL Gateway Residences, but the key difference is pretty stark. Those developments are generally defined by much higher density, smaller average unit sizes, and they're targeting broader markets, young professionals, smaller families, maybe first-time buyers in some cases.
So the estate isn't really playing the same game.
Not at all. It truly defines its own niche. It doesn't compete directly with those other Bangsar South condos. Instead, it operates in this sort of super luxury high-rise category. It's catering to people who want the scale, the feel of a bungalow. But they prefer the security, the services, the lock-up and leave convenience, and the amenities of a condo.
So its real competition is different.
Yes. Its real competition isn't necessarily other condos nearby, but more like high-end landed properties in established prime suburbs. Think Bangsar proper, Bangsar Heights. Its whole value proposition is built on that scarcity of large, luxurious, high-rise units and the exclusivity that comes with low density.
That's a really important distinction for potential buyers or investors to grasp. It's not just another condo. Okay, let's turn to the developer behind it all. Bon Estates. SDN-BHD. What's their story, their track record?
Bon Estates, they actually started life as PPM Realty. Their origins are in Penang, mainly doing landed developments there, things like White Lily, Minden Gardens. They built a reputation there first. The estate at South Bangsar was really their flagship entry into the much more competitive Kuala Lumpur market, their big statement project.
And it seems to have paid off recognition-wise.
It has. The project won a prestigious FIA-BCI Malaysia Property Award.
For those of us not deep in property awards, what does FIA-BCI signify? Is it a big deal?
Oh, it's a very big deal. Think of the FIA-BCI Awards as like the Oscars of the global real estate world. It's judged independently, rigorously, across many criteria: architecture, development, marketing, community benefit, sustainability. So winning one gives you, as a buyer or investor, strong third-party validation of the project's overall excellence and vision. It adds a layer of confidence.
Okay, good to know. And their philosophy.
Their brand philosophy is living, well-crafted, apparently inspired by a Tibetan concept, Boen, which is about harmony, balance. And it's not just, marketing speak. It seems to manifest in things like their unique 3-story show experience gallery they built. It was designed to give a very holistic feel for their design thinking.
Interesting. And what about their future direction? Does it look like they're sticking with this high-end, large-format strategy?
It certainly looks that way. Their second major KL project, Bon Kiara in Mont Kiara, strongly reinforces that commitment. Bon Kiara also features large family-focused units, lots of green space. It's clearly targeting a similar affluent family segment.
And how's that one doing?
Very well, apparently. Reports suggest it hit a 95% sales rate even before completion, which indicates strong market acceptance for this type of product. So this strategic consistency is actually a positive indicator for you. It suggests a developer that really understands its niche, knows its target market, and is building a brand reputation specifically around this high-value, large-format, luxury home type. They're not just dabbling.
Right. They seem focused. Okay, let's bring it all together now. Time for the synthesized verdict. A clear scorecard, pros and cons, specifically tailored for you, whether you're thinking of living there or investing.
Okay, let's start with the owner-occupier, the person planning to live there. The pros are pretty compelling. First, that unmatched living space, truly landed living in the sky. Second, exceptional privacy and exclusivity thanks to the low density and those private lifts. Third, the comprehensive resort-grade facilities, which, as we heard, get rave reviews. Fourth, that underlying 100-year home philosophy, suggesting durability and quality materials, at least in intent. And fifth, you get that choice of premium views, the serene Bukit Gasing Forest, or the dynamic KL City skyline.
Okay, those are strong positives. What about the cons for someone living there?
Well, first, the high financial outlay. It's an expensive property, no doubt about it. Second, that sanctuary versus reality disconnect we talked about. The very serene inside versus the busy, noisy, high-density outside, including the proximity to the low-cost flats. Third, the ambient noise factor from the federal highway, the LRT line, plus the ongoing construction noise in the vicinity. You have to be prepared for that. And fourth, crucially, that anecdotal report about questionable finishing quality. It means you absolutely must do your own thorough inspection. It's a potential risk you need to mitigate.
Got it. Okay, now let's flip the coin. For the prospective investor, what's the pro-con picture for your investment portfolio?
All right, for the investor, the pros. First, that proven high rental yield, consistently beating the market average. That's a big draw. Second, it's a scarce and niche asset class. Less direct competition for tenants seeking this specific type of large luxury unit. Third, there seems to be strong capital appreciation potential, given its unique positioning and the trends we've seen so far. And fourth, attracts a generally stable, high-quality tenant profile. Think expats, corporate leases who value the space and amenities and often stay longer.
Sounds attractive.